I want to spend a little bit of time discussing what we think, what kind of you and I think are the most impactful trends for 2022. So I'll start. Number one, interest rates. I think it's the easiest one. That I think is the biggest trend for 2022. They started low, ended up high. The biggest run up in the federal funds rate in decades. And I really think it's so easy to put this one on top, other than the fact that we and every other economist has been talking up every bump in the road of interest rates for the whole year. But to oversimplify, to oversimplify the importance of interest rates for the multifamily investment market, higher interest rates means that loans to buy apartment buildings more expensive, which means that buyers' return projections go down. And that means that buyers are going to say no to higher prices because they need to hit those returns. And then that means that sellers are going to have to lower their prices because buyers are not biting on their prices. I think the same thing in certain ways is happening in the single family market, but affordability instead of returns. Because the interest rate issue has such a direct link to multifamily returns, and it has real effects on housing and the economy in general, it's not a real shocker to say that this was a major trend in 2022. And I think it's a very 2022 trend, and not something, hopefully, this is wishful thinking, that's going to happen or continue in 2023. The projections, and we can go on the dot plot that I'll have linked in the notes, but the projections don't have it much higher than 5.25. Some real hawkish dots are up near 6, but most of them, I don't think we're going to see another run up. This was a purely 2022 phenomenon, and I don't think it's something that we'll see for years to come.
Yeah, well, I think that's the most important and probably the biggest factor that investors are focusing on right now is, and it has been for a while, but interest rates, and the big difference and the big change for comparing 2022 to 2023 is hopefully some plateauing and stabilization of those rates. And I think it's going to be an end of hibernation of a lot of buyers, and the market is going to finally thaw, and there's going to be more price discovery because you can plan. Again, to do a deal starting back in April and March, you had no idea where your interest rate was going to be when you'd close. Yeah. And so that just made it the risk profile of transacting incredibly high. It was very difficult. We did it twice, or we've done it 3 times. Sorry. Technically 4, I guess, this year. Yeah. And we've been able to navigate. I guess one very early in the year as a Co-GP, Club Meridian, Stony Brook, and Sycamore. And none of those were easy, and there were a lot of kind of nail biting moments throughout the process. But that was all driven because of volatility, and the 10-year just ran, and loan proceeds just got taken away and destroyed, and return profiles, and so you have to either pull out of the deal or renegotiate, and none of that's ever fun. But if rates plateau, and just to your point, if we look at the dot plot and what people are saying, not that things haven't changed and will change, but we're looking at a terminal Fed funds and SOFR, in the 5 to mid 5s. But it's probably not going to go much beyond that, or that's at least conventional wisdom. And so that allows you to plan a little bit more. Because, like, for example, and it opens up strategies as well, and ways you can execute. For example, we stopped doing bridge loans this year because we're like, well, I'm starting at a 3.5% rate sounds attractive, but it could get to 7%, and the pricing is based on the 3.5% rate, and the cap rates are still low. Well, now cap rates have expanded a little bit. The prices are a little bit more favorable. There's still some gap, but deals are definitely popping up that pencil. But now, instead of being like, I hate to assume a 6 or 7% interest rate, because that just seems, it hurt to do. It hurt to plug into your model for a period of time. But now it's like, this is what it is. And you had to do that. But now all of a sudden it's like, okay, well, we feel more comfortable that SOFR is going to be in a range of kind of 5.5%. That allows you to maybe take out a bridge loan that gives you more flexibility on an exit, that allows you to, finance the renovation of an asset. And we are seeing tired owners, and a lot of it's institutional owners that are getting tired that don't have the right management. You'd think that these big companies like REITs would be like good at managing the properties, and there's some that are, but there are also that are they're institutionalized to a point where, you know, for lack of better terms, like the soul has been the soul has been removed, and they are functioning. These assets are being managed, but just barely.
Yeah,
like they are barely functioning, and so we're seeing a lot of opportunity for just we're joking. It's like, I mean, yeah, we're gonna really manage it and actively manage it, but like just any sort of actual management would be an improvement from no management, no oversight.
Yeah.
So there's a lot of operational opportunities from tired sellers of some high quality assets, and I also think as growth is slowing, I think we're going to see I think we're going to see growth above 2%, that we would see in previous years. I mean, like GDP growth and inflation. I think we're going to be in the 3 to 4% range. I think we're going to see some decent growth, but I think we may see some more value add opportunities come up of where some, I mean, not too old of vintage, but some assets that just the rents are still hundreds of dollars below where the rest of the market is right now, and there's some meat on the bone. So we're seeing some opportunities come up. End of 2023, I think, is when the most opportunities will be coming available. But I think that we're going to see so many buyers coming back into the market that it's going to keep prices relatively high. That being said, and I was thinking about this last night, where everything in 21 was trading for call it 3.5 to 4.5% cap rate range. I think we're going to be reverting back to cap rates of several years ago, of where only assets on primary markets, trophy assets on the coasts are going to be trading for anywhere in the 4% range. Yeah. Like there will be some, but like they're not going to be, they're going to be no leverage, low cash flow deals that big institutions are parking money in. Those probably still trade in the 4 cap range. A premium deal in a good market is probably be in the 5 cap range. A B class deal or something in a non-premium market is going to be in the, I think, 6.5 range. And I think something that's, real true workforce, C class, it's going to be back into the 7 cap range. So I think we're going to be seeing 5s, 6s, and 7s, maybe even a little bit of a wider spread versus everything trading for 4.5 or so. Yeah. And I could be wrong. It could be more compressed than that, but we've already bought an asset for a mid-6 cap. A nice quality deal this year. Yeah. So it's definitely possible, and it's all relative to interest rates. Again, like if interest rates are staying around 5%, which is basically the long-term average of interest rates, so like we've reverted to the mean, there's cap rates need to be in some relation to interest rates, because there's other opportunities for income. I mean, real estate is a growth and income investment vehicle, but it's often looked at as an income producing vehicle. And if you look at other types of fixed income alternatives, there's other options out there that are yielding much more than multifamily right now. Now, the risk profiles may be different. You may not be as comfortable with it. They may not have the tax benefits. You may not have the equity kind of upside growth potential. But, I was just having a conversation with a venture debt fund today, and they're paying 16 and 19% cash on cash. Yeah, yeah. Now it's a different. It's really good. Other private credit 9%. Municipals 6%. So again, different risk profiles. Some higher, some lower. Your debt versus equity. So the different areas of capital stack, but not as much upside. But you can't get away. But it's hard to justify 4% cap rate deal on a multifamily in a okay market. Yeah. When you can go out and buy something that's yielding double that. Yeah, so that all ties back. It really does tie back to interest rates. It's changing the alternatives that are available, or the priority, the value of these alternatives to maybe multifamily. It's changing the multifamily market itself. And I think what you noted too was the fact that it is moving. It was a moving target in 2022. If it was just high, interest rates would still be important, but it would change the character of the market, change the kind of actions that have to happen in the market, and eliminate a lot of
of those awkward conversations that you're having as the interest rates are changing. So being able to predict things is super great. Even if times are bad, being able to predict what's next is a lot better than times are bad and uncertain.
Well, it's like, okay, if you've ever done any sort of like target shooting or shooting, the difference between shooting a stationary target and a moving target.
Yeah.
Moving target, there's a lot more variables that you have to take into account, or landing an aircraft on a moving runway or on an aircraft carrier.
Yeah.
It's both can be done. Mm-hmm. They both require a different set of skills and fortitude and exactly. But the risk is a lot different.
Yeah.
Especially the way how you do it.